Well, just a briefly introduction. I'm Kim Jargowski. I'm the business manager with Premier Tax Repairs. Our main office is in Aberdeen. We do have locations in credit unions across South Dakota, just like we do here at Sioux Empire. Our team is made up, we have 6 tax preparers. We're all up in the Aberdeen area. We do have a Spanish interpreter as well that we've just brought on. So she is able to assist clients that need that special assistance with Spanish as a first language. I always say taxes are hard enough to understand in English, so I can't imagine what it's like if you don't speak English as a first language. So we did bring on a Spanish interpreter to help with that. Has anybody ever heard of us before, Premier Tax Preparers? He's shaking his head. Yeah. Okay, good. Like I said, we specialize in helping people across South Dakota. Our main office is in Aberdeen, but we thrive on helping people in communities all across the state. We don't want to limit who we're able to help. And so we have several options on how we work with our clients. We'll talk about that a little later. Oh, I know what I've done. I did print out little handouts for everybody of the slides, and that way if you have any notes you need to make or anything like that, you can sure jot them down. And if you need a pen, let us know. We'll get you one. The hardest thing in the world to understand is the income tax, and Albert Einstein said that. The tax law book is huge, and to be able to know everything that's in there and understand everything that's in there is very, very difficult. So he is not out of line to say it's the hardest thing to understand. There are Publication 17s is a great resource that tax professionals use. And this is just a simple resource that we can have whenever we're working on a tax return. If we have something that we need to look up real quick, this is kind of a quick resource, and you see how that's that big already, just for a quick resource. Every year, tax law changes. So that makes our job really fun because we really have to stay on top of things all year long. It's not just January through April job, it's actually all year job. We have to continually be on top of things. We have to go to seminars and take classes and read these books. This is just for 2011 changes, and that's how big it is. So things can be very, very complicated. What I want us to do today, because tax is overwhelming for some people, I wanted to do a breakdown of just the basics about taxes. I'm not going to teach you how to prepare your own taxes. I'm not going to get into a lot of depth on some of these topics, but I'm just going to do a general overview just so you can get a good feel for whether you do your own taxes or if you take it to a professional, that you kind of have the lingo that that you need to know to be able to do your own tax return, or to work with a tax preparer to do it for you. And just give you hopefully some tidbits that you can take away and that are beneficial to you. So we're just going to go over the basics. Like I said, they're going to be what is the filing status, what are dependents and exemptions, what are tax brackets. You hear about those a lot, your income levels. What counts as income, what's a deduction, what does education have to do with taxes, what different life events can affect your tax situation, and then 2011 tax changes. And like I said, this is the book for just the changes for 2011, and so I just picked things that I felt were relevant to let you know about for this year. And then we'll talk a little bit about e-filing, electronic filing with the IRS and record keeping, and then we'll just do a little feedback and questions if you have any of those. So filing status, and we'll just jump right into it. Filing status, there are 5 different statuses that you can choose from when you do your tax return. And these are all relating to individual tax returns. This is not anything to do with your corporation or LLCs or partnerships or anything like that. This is just a 1040 return. So the 5 filing statuses are the single, head of household, married filing joint, married filing separately, and a qualifying widower or widow. This is important. A lot of things, a lot of the tax calculations and figures are based on your filing status. And if you pick the wrong one, if you're not qualified to, if you're married, you cannot file as a single person. So you need to know which one you can be, which one you can choose to file, and that way you avoid penalties and correspondence from the IRS, because most people do not want that. So how do we know which one to choose? There's 8 facts to help us determine our filing status. And our filing status, like I said, is used to determine your requirements, your standard deduction, eligibility for credits and deductions, and the correct tax amount. So the first fact is your marital status on the last day of the year determines your marital status for the entire year. So if you were married all year long and you're getting a divorce, and your divorce was final on the last day of the year, you're technically divorced the entire year, as far as for tax-wise goes. And so that does affect your tax return, because you're now taxed differently than you would be if you were a married person. You would now be as a single person. If more than one filing status applies, you can choose the one that gives you the lowest tax obligation. So if you do qualify for a couple different filing statuses, you can work with your tax preparer to go through the different options and see which one's going to give you that lowest tax obligation on your return. The third is the single filing status generally applies to anyone who is unmarried, divorced, or legally separated. So of course, if you're married, you couldn't file single, like I said. And if you tried to do that, actually, I've seen people do that. And we have to go in, of course, to an amendment to fix that tax return. They will get letter after letter from the IRS, and you'll get lots of penalties and interest on that for filing the wrong status. Number 4, a married couple may file a joint return. It's pretty self-explanatory. Number 5, if a spouse dies and you didn't remarry in that tax year, usually you may still file a joint return for that year of death. So if you did have a spouse that happened to pass away at the beginning of the year or anytime during that tax year, say it's 2011, you could most likely still file a joint return with that spouse even though they have passed. You would still be able to claim a married filing joint return and get those additional benefits of being married. 6, a married couple may elect to file separately. That is an option. It's not always the best one, but depending on the situation, it's possible. Number 7, head of household generally applies to taxpayers who are unmarried. Now, you must have also paid more than half of the cost of maintaining a home for you and a qualifying person. So it can't just be you by yourself. You have to actually have a qualifying person, would be like a child or another dependent, to get to qualify for the head of household. And then number 8, you may be able to choose the qualifying widower with a dependent child if your spouse died in 2009 or 2010 and you have a dependent child and you haven't yet remarried. So that also gives you different tax benefits between that. Now we'll go into some dependents and exemptions. Dependents and exemptions are, a dependent is a qualifying child or a qualifying relative. So if you are taking care of your sister's children or your nieces and nephews, some type of relative, they can qualify as a dependent if you are caring for them. And an exemption is something that you can claim for yourself, for your spouse, for each qualifying child or relative, if certain tests are met. And so depending on when we're working on your tax return, we would, of course, need to know who the qualifying children or relatives are. Of course, if you're married, we get all that information, and determine how many exemptions we would claim on your tax return. And then each exemption, each person basically is $3,700 value, I guess you could say, on your tax return. So that helps to reduce your taxable income. So. Some more facts about dependents and exemptions. As I mentioned, exemptions reduce your taxable income, so those are a good thing. Never met anybody that wanted to pay more in tax. Okay, number 2, your spouse is never considered your dependent. 3, generally you take exemptions for each dependent. 4, if someone else claims you as a dependent, you may still be required to file your own tax return. This one I'm going to touch on a little bit. So if you have a student, say if your child is older and works, and they earned enough money to have to file their own tax return, you can still claim them as a dependent. So you get that benefit of them being your exemption. But they still also have to file their own tax return. And there is a section on the tax return that says, can anyone else claim you as a dependent? And if so, you would check that, and they don't get extra benefits of being their own exemption.
What is that income threshold?
For
The dependent, like if my son's working, at what point has he earned enough where he has to file his own separate taxes?
Yep, I'm pretty sure it's $3,200, but it's just over that $3,000 mark. Yep. Number 5, if you're a dependent, you may not claim an exemption. Yep, so and then number 6, some people cannot be claimed as your dependent. So there is, again, like I said, it's very in-depth on all the different tests that you have to qualify for to get some of these tax benefits. So I just want to give you kind of a brief overview of some of these things. Okay, tax brackets. Who knows what tax brackets are? He doesn't. Sounds good. The tax brackets are ranges in income, and depending on your income, you get taxed at that level. So there's the 15% bracket, the 25% bracket, the 28% bracket, 33% bracket, and the 35% bracket.
You only get taxed 15% up to that dollar amount, and then anything over it is taxed at 33%, correct?
Okay, say it again.
Say that you made, $38,000 a year, you pay 15% taxes on the 33,000 something, and you pay 33% on the dollar amount that's over, that exists in the 20 whatever percent tax bracket, correct?
Not necessarily, because it'll be based on your adjusted gross income. So that's why we all have to fill out W-2s and have a certain amount withheld. Whoops. So we try to estimate when we have withholding come out, we try to estimate what, based on our income, is going to be to make sure that we're paying enough on a percentage. So, so that range, so like if you were single, your filing status is single, your income level is anywhere from 0 to 8,700, you're in that 15% bracket. If you're married filing a joint return, if you were 0 and your adjusted gross income is between the 8,701 to 17,400, then you would be in that 15% bracket. And so those are all figured on the tax return for you based on the different income levels. It could tell you that you're in the 33% tax bracket, but the effective tax rate might be the 15%. So it will actually, when we do taxes, that does a return summary for us, and it tells us which one you actually end up being taxed at. So,
Explain effective bracket. What's the effective percent tax bracket?
the effective percentage of the
Yeah,
tax.
you see, like, for example, my income is, let's say, $178,000.
Mm-hmm.
And 178 minus 85,650 is 28%, and the remaining amount would be 33%. Now, what is the effective?
I guess I'm not sure what you mean exactly.
The effective tax bracket? You just said it before.
Yeah, what do you think? Were you saying that if I made $90,000, then automatically be in a 33% bracket if I was single? Is that what you're saying?
Well, if that was your true income, if that was not
My
your
adjusted
adjusted
goes to
everything.
$90,000.
Right.
Well, I'm single, so I would be a 33% bracket.
Yep.
Like he said, I couldn't take 85,000 off and pay 28 and then pay.
No, I think that.
No.
That's right.
Mm-hmm.
So you're in that bracket, whatever your adjusted gross is.
Yep. Yep.
I don't think that's correct.
That's not true.
No, I didn't think so either.
I think that anything.
You don't pay a flat 33% on it. It's staged.
Yes.
You pay 15% on the dollar amount in that bracket, and then you pay the whatever 28% in the amount that exists in the next bracket, and then you pay 33% on the amount that exists in the next bracket. They don't tax you a flat 33%
Right, it's
on
not
your
a
income.
flat tax.
It's
Right,
not a
and
flat
that's why I
tax.
say it's adjusted, and that's
Yeah.
why when we break it down.
That's what I was saying,
Yeah,
was
that's
when I
right,
explained
yeah,
it.
right.
is
That's
you-
right.
The
Yeah.
effective.
You're taxed only that dollar amount on the amount of money you make that exists in that bracket. So,
Right, that's
Yeah.
the way to put it. Yep.
Yeah.
Yep.
I'm with you.
Yep. Okay, so income. What can be income? There's taxable income and non-taxable income, and some that may or may not be, depending on different qualifications. So, of course, taxable income is your wages. You would get your income from your employment. If you have any 1099s that you receive, salaries, of course, tips, unemployment insurance, non-taxable adoption expenses, reimbursements for qualifying expenses, gifts, or bequests or inheritances, workers' compensation benefits, exceptions may apply, meals and lodging for the convenience of the employer, compensatory damages awarded for physical injury or sickness, welfare benefits, cash rebates from a dealer or a manufacturer, and may or may not be, just depends on the situation and the different tests again, is the life insurance, scholarships and grants, and non-cash income. Non-cash income could be something like bartering, you've heard of that. Deductions. Deductions help reduce our taxable income as well. So standard deduction, there's the different levels for single person, married filing jointly, and a qualifying widower. The standard deduction $11,900, head of household $8,700, and married filing separately is $5,950. That's treated just as if they were single. Itemized deductions are medical and dental expenses. I'm going to go into that a little bit more in depth in the future here. Taxes you've paid that could have been real estate taxes, personal property taxes, sales taxes, income taxes, things of that nature. Interest paid, casualty and theft losses, and then miscellaneous. Does anybody know what might be some miscellaneous deductions?
Would you need to purchase a car in that year?
no.
That would actually be your sales tax. Yep. Miscellaneous would include safe deposit box rentals. So if you have safe deposit box, you can actually deduct that. Or tax preparation fees. Those are also miscellaneous deductions.
Chairs.
What's that?
charities?
Charities, yep, charitable, yep.
Are there moving expenses if you move your residence?
There are job-related moves, so that would be listed separately as a move expense. Okay. Now, some medical and dental, there were some things that have changed in the medical and dental expenses, I guess. Prescription drugs are deductible. Hospital service fees, meals and lodging that's provided by the hospital are primarily for medical care. If you had to travel, say had to travel to the cities or to the Mayo Clinic or something like that, for specific medical care you had to cover meals and lodging. Some of that may be deductible. Medical service fees, Medicare Part D premiums, medical and hospital insurance premiums, any oxygen equipment and oxygen, your annual physical exams, also special items like eyeglasses, contacts, hearing aids, false teeth, or even wheelchairs, things of that nature. Your transportation to get your medical care. So that could include your gas or your mileage, your bus fare, your taxis, you name it, whatever it takes to get there, the ambulance, whatever it takes to get your care. Wages for nursing services. So that would be if you were to do assisted living, something of that nature, you would be able to deduct that. Eye surgery, stop smoking programs, weight loss, certain expenses for obesity. So those are some different things to help you get a good idea of if you think you might have to itemize on your tax return and you've had a lot of medical or dental things happen to you in the year. Anything that you've paid, even though you may have incurred the expense in the year, you have not paid that bill, you cannot deduct it. So, you might have racked up $100,000 worth of bills, but if you didn't actually pay the $100,000, you couldn't deduct the full $100,000 in bills. So whatever amount you've paid, that's the amount that you can deduct.
Is that any change on that medical and hospital insurance premiums? Did that change at all this year?
If you incur the medical expense, say in 2010, paid it in 2011, can you then claim it for your 2011?
Absolutely.
Regardless of when
Yep.
you incurred it?
So, when you get large medical bills and you pay monthly payments to them or anything like that, you deduct it the year you're paying it. So if it takes you 10 years to pay off that expense, you just keep taking whatever you paid each year. Want some more chocolate?
The reason for my question about the medical or the insurance or whatever, because, if the employer pays you a percentage of it, I was thinking deductible.
Well, that could be a little different, because that's a health
Okay.
savings account. Eight things to know about medical and dental. Be able to deduct qualifying medical and dental, you have to itemize your tax return. Deductions are limited. You can deduct the total medical care expenses that exceed 7.5% of your adjusted gross income. So if you ended up paying $100,000 out in 1 year, you can deduct anything over that 7.5% of your adjusted gross income. Does that make sense? Expenses must have been paid in 2011, like I said, or in the year that you keep paying those expenses. You can't deduct reimbursed expenses. So if you paid a doctor's office visit, but then you got reimbursed for that from somewhere, you cannot deduct that as an expense that you paid. Whose expenses qualify? Anything you pay for yourself, your spouse, or your dependents. So again, dependents are your qualifying children or a qualifying relative. If you have paid those expenses for those people, you can deduct those. Types of expenses, there's a slide before that, so you can see that list of the various types of expenses that qualify. Transportation costs primarily for the medical care, the tax buds, train, plane, everything we need. And then distributions from health savings accounts and withdrawals from an FSA account may be tax-free if used to pay qualified medical expenses. So those types of accounts where your employer might contribute to that health savings account for you. Basically, when you go and incur a medical expense, you have to tell them that you incurred that, and they would then distribute that money to you to pay that bill, right? So those distributions from that health savings account would then be tax-free because it was used to pay a qualified medical expense. Okay, education credits. Does anybody have a student? Yes?
Yes, me.
Anybody is a student? What's that?
Me.
You are a student? Very good. So there's some different education credits that you can get for having a student or being a student. The American Opportunity Credit actually replaced the Hope Credit that was available in the years past. And it has been extended for additional 2 years, which covers 2011 and 2012. And it's also made available to a broader range of taxpayers to take that American Opportunity Credit. The maximum annual credit is $2,500 per student. And then the Lifetime Learning Credit, that helps parents and students pay for their post-secondary education, of course. You can claim up to $2,000 for qualified education expenses. And there's no limit on the number of years that can be claimed. So if you are an ongoing student forever and ever, if you don't necessarily, if you're not after a degree and you just keep taking classes, this is a really nice credit to take because you can keep claiming that. But you cannot claim both credits. So you would want to figure out which one is going to give you the better advantage as far as that goes. There's also the tuition and fees deduction. So the tuition and fees deduction can reduce the amount of your income subject to tax by up to $4,000. You may be able to take one of the education credits for your education expenses instead of a tuition and fees deduction. And so again, you want to choose the one that will give you the lower tax when figuring on your taxes and your tax return. You can claim the tuition and fees deduction if all three of the following requirements are met. If you have paid qualified education expenses for higher education, if you paid the education expenses for an eligible student, or the eligible student is yourself, your spouse, or your dependent for whom you can claim an exemption on your tax return. So again, if you have a student in your family, or if you are one, these are some good things to look into in taking on your tax return.
If you receive any kind of federal aid, such as a Pell Grant or whatever, that's taken off the top of that. You can't, that dollar amount, so it's subtracted right from, the $4,000. So if you got $1,000 from the government, you're not going to get $4,000 in credit. You only get $3,000.
Yep.
That's assuming you paid that much for school.
Right. Yep.
So.
Yep. Good point. More time. I'll give you 3 because you participate a lot. Life events that affect your taxes, and things happen in life that we just don't really realize affect a whole array of things in our life, but it does. And taxes is one of those things. Marriage, divorce, having a child, adopting a child, or if somebody dies, those are really 5 huge things that change how your taxes are done. Of course, if you're newlywed, you're now going from a single person, probably have done your own taxes, to now going to file a joint return, which gives you a bigger deduction amount and exemptions, things like that. Divorce, again, like you mentioned earlier, if you were divorced, whatever your status is on the last day of the year is what you were for the entire year, and that's how you're treated for taxes. A new child has probably brought on medical expenses. but there's also things that you can now claim them as a dependent, so you get additional benefits from that. And there's child tax credits that you may be able to qualify for as well. Job-related move, somebody brought that up earlier. If you have a job-related move, there are different figures that we use to determine how much of that move can be deductible for an expenses. If it's further than 50 miles away from where you were working before, then it's likely deductible. So those are just some different things that we would have to figure out to make sure that you would qualify to claim. You know, if you had to rent a truck to move or hire a moving company, your mileage due, things like that would all be on that deduction. If you were to get laid off, or if you know somebody that was laid off, that can definitely change things because now they don't have their normal income, but they might be starting to receive unemployment compensation. So that could affect their taxes as well. If you started a business, that adds something new to your tax return. You might have to start filing a Schedule C. Even if it's a small home-based business, something like that, it could be all those expenses you've incurred for your business would now go on your tax return as well. And then of course, anything major, medical, dental, those could happen at any time, and it might not be standard that that's there all the time. One year you might have to do itemized for all those medical bills, and some years not. And if you've purchased a home, that can affect your taxes. You're going to have the real estate taxes, and if you have closing points and things like that that we can claim on the return, we would certainly do that. Some of the 2011 tax law changes, like I said, I just picked what I felt was the most relevant. I'm not going to go into everything because we'd be here for a couple days. The due date this year, they changed it to April 17th. Normally you would hear April 15th. Everything's due by April 15th. This year it's the 17th. The 15th falls on a Sunday, so it was going to be the Monday, the 16th. Well, Washington, D.C. observes a holiday on that Monday, so now we have a due date of April 17th. So we got 2 extra days to file and pay any taxes that are due. So that is a great benefit. There are a couple new forms that the IRS added. They're the 8949 and 8928. And these are both related to capital gains and losses. So if you have any type of tax statements or anything that you need to talk to somebody about capital gains and losses, you might have to deal with these new forms here. The repayment of the first-time homebuyer credit. You may have heard about this. It's a big push in 2008 to get people to start buying homes again with the market crashing. So with the tax credit, the first-time homebuyer credit, people that have never purchased a home could buy one, and they would get a tax credit of up to $8,000. Now that that's passed, they must start repaying that $8,000.
It's like a loan. It's not really.
Exactly.
I like the way they made it as a home buyer credit.
It was kind of deceiving, and a lot of people don't know that they have to repay it, which is not a good thing. So when we prepare returns and we tell them you need to make a $500 payment towards your home buyer credit, people just don't understand what we're talking about.
Well, didn't they have various, because they had a couple different changes to that, didn't they? Like, there was, like, this time frame was, you had a repayment. This time frame, if you stayed in your house for 3 years, you didn't have to repay this time frame. So it's not a general statement across the board, right?
Not everybody is going to have a repayment. That's a good point. Yeah. Sorry. Nope, that's a